If you look at the chart of SPY, S&P 500, it looks like a triple top here. When you look at the S&P 500, just as of December 31st, right? 37 to 38% tech. Guess how many, guess the percentage in mining stocks? 0.1%. You don't own any mining exposure. You don't own any gold exposure. Like these charts are kicking butt and you're not participating. These silver equities are going to crush it over the next couple of earnings quarters because
it's the 12th of February, and markets are extending their losses. The S&P is now at 6,800 points. It's down about 1% from the previous trading session. Gold is extending its loss down now 3.5% to below $5,000. So we'll talk about what's next for the entire market. John Feneck joins us once more. He is a founder of Feneck Consulting. Welcome back to the show. John, good to see you.
Yeah, likewise, David. Thanks for having me.
You have been warning us of volatility for quite some time. You were on the show back in October when I was speaking to you at the conference in Colorado, the Beaver Creek Conference. So stock markets have been grinding slightly higher since then, moving sideways. And ever since basically this past week, a lot of news about tech sell-offs leading the charge. And now we're seeing heightened volatility across the board. Tell us what's happening with the stock markets, and I want to get your thoughts on commodities as well.
Yeah. So I think we were early last year calling for a Q4 kind of correction in the S&P Russell kind of thing. But I feel more confident now that is going to play out in 2026. If you look at the chart of SPY, S&P 500, it looks like a triple top here. It really didn't have any good follow through at all today. And we're in the middle of earnings season, David, right? So we're going to get volatility. But I looked this up for a client. If you look at Tesla, TSLA, and you look at Apple, AAPL, just draw a one-year chart from last year, Jan 1 to December 31st. There's a lot of volatility in those stocks, but you pretty much broke even in some of these names, like if you just bought and held. And that's what we're trying to relay to people, is that this rally started in the broad market in March of 2009. This is like a gift if you're an investor, that things don't last usually this long in history, where you have 16-year rallies with brief pullbacks, right? So I think a 20% correction in something like the Russell or the S&P this year is not out of the question at all.
It seems to be AI disruptions are leading the charge when it comes to investor fears. We have news that updates to Claude, for example, could wipe out entire ecosystems of software, and software stocks went down earlier last week. And it seems to be AI specific. So as an investor, how would you be positioned for a future where every single time we have iterations of AI advancements, entire sectors could be at risk?
Look, I mean, we've been saying for months now, this is not a casino, and people treat it like a casino, right? You're seeing this kind of selling in the commodity space, which we'll get to in a minute. And it's because people are overextended. They're on margin. They're gambling. This isn't, a casino. You have to look at it and say, how much can I afford to lose, right? Like that's the best way to approach the market at this, the broad market at this juncture, because it's so mature, this rally. Like we've had a 16-year plus rally, people. Like, take some money off the table and sit on your hands for a bit, if nothing else, right? Like this is just unprecedented times. So there's going to be a lot of books written about this kind of time period here.
Yeah. So let's take a look at some of the stocks here. So Palantir's down about 27% already on the year. We have 38 actually. So the NASDAQ is down 2.5% year to date. And AMD, I'm just pulling up some names in the headlines recently. AMD has not had a good start to the year. Actually beat earnings in the last report, but still down 17% on one trading session. It seems like this correction is already underway. And so it's not future tense anymore. We're living in it right now. Where's the, I'm not asking you to draw up a crystal ball here, but how can we gauge where the bottom may be? What kind of headlines are you needing to see? What do you need to see in the news before you can kind of make the assessment that maybe it's time to get back into risk assets?
Well, you can't listen to things like CNBC. These guys are perennial bulls. Like, I mean, you'd have to see like an 0809 correction to see these people actually come around to the fact that we're in a correction, as you just suggested, right? Like they're just going to keep talking their books and be bullish, right? So you have to, as a client, think independently. You need to work with professionals like myself or your financial advisor to help you a little bit through this time, because it is going to get volatile.
Right.
So I use stockta.com, which is a free website to generate support and resistance levels on any stock. It's free.
Okay.
So you just put in the AMD, right, as the ticker in the top center. And then on the right-hand side, it'll show you support and resistance for AMD or any stock you want to look at. And it's a good gauge to check yourself. I check myself all the time, David, just to make sure before I buy something or sell something, hey, let me just see where the support is, where the floor is, and where the ceiling is, the resistance level. And that will give you more confidence as an investor in terms of where to enter and exit.
Where do you think we are in the cycle right now?
Which cycle? Are you talking broad market or commodities or?
Let's talk about stocks first, and then we'll move on to commodities in just a bit.
Yeah. I mean, the broad market is way overvalued. We're short the Russell. We're short emerging markets right now, the riskier stuff, right? Because that stuff has done extremely well over time. So we're taking a concentrated bet against the risky stuff. I mean, why would you want to be long emerging markets right now when Trump is going after every country nameable, right? Like, to me, it makes no sense. I hear these arguments all the time on, emerging markets and international are our favorite idea this year. Really? Look at the headlines. This is huge geopolitical risk we're entering right now. And we're entering an age of protectionism where people are being, countries are being more careful with everything they say and do. And, this is evidenced by gold, right? Gold since February of 2022, when the Russian war started, you're seeing central bank buying like through the roof. It's not just China, it's India, it's so many names that are taking, not just buying it, David, but then taking their gold back from places like the US and Canada, right? And that repatriation is something that clients don't understand how important this is, but it definitely doesn't bode well for risky emerging markets, in my opinion.
Okay, let's take a look at some metals now. Gold is down about 11% from the top. It was down 20% at one point. Are you taking profits if you haven't already on precious metals?
We have a small physical gold position. It's just over 1%. I buy gold equities, David, and hopefully we can talk about a few names. I mean, my portfolio as of December 31st was 51% gold equities. So I am looking at what this chart looks like, which is beautiful to me. A series of higher highs and if you looked at a 20-year chart, it looks ridiculously good. But I would say that gold has some support at, the recent low, which was, I believe, 44 to 4,500. And then, of course, a big round number like 4,000. And we're trading right now at 4,900, almost on the nose, a little bit above. So there's some downside risk in physical gold. But like when you look at banks this year, UBS yesterday just went to 5,900, not a small shop. Actually makes pretty accurate calls for a broker dealer on gold and silver historically. JP Morgan's at 6,000, which is insane, insanely good, because I'm not a contrarian in that regard. Like I like to see big banks and broker dealers start to come around to our narrative, because these guys are powerful, right? Goldman Sachs is at 5,400, B of A is at 6,000. We can go down a list, but let's just say it's in a range of 5,000 to 6,000. Why we're underweight gold, given that statement, is because we're overweight gold equities, because if we're right and the banks are right, gold equities are going to crank this year.
Before we continue with the video, let's talk about today's sponsor, Monetary Metals. With gold prices having hit all-time highs, we know why people hold gold. It's because it's real money. But what if your gold could do a lot more than just sit in a vault? Well, that's where Monetary Metals comes in. They offer a way for you to earn a yield on your gold paid in physical gold. Through their leasing marketplace, you can earn up to 4% yield per year in gold. That means instead of storing your gold in a vault and letting it sit idle, you can lease it out to vetted businesses in the gold industry and get paid in more gold. Thousands of investors are already earning a monthly yield in gold and silver through Monetary Metals. So scan the QR code here or go to monetary-metals.com/Lynn. Link in the description down below to learn more. Don't just hold gold, put it to work. So let's take a look at gold equities in comparison to some other things. Well, let's take a look at the materials index. So that's IYM, Basic Materials ETF. Over the last, let's just take 3 months, up about 24% versus the Nasdaq's. I'll give you the Nasdaq's. It's down 3.5% on the same period. GDX Gold Miners ETF from Feneck up 23%, beating both slightly. The point I'm making is that investors have noticed that there's a bit of a rotation, not a bit, but quite a bit of a rotation from high-tech stocks into materials and mining. And in fact, I read an article on CNBC not too long ago saying that investors are moving in away from innovators. 21st century innovators was the words they used in this title, in the article, into 19th century businesses like mining and materials, industrial, so on and so forth. So moving away from the new back into the old. Now that the rotation has already happened, though, or is in the process of happening, what do we do?
Yeah, so the average portfolio is way overweight growth right now, and that's the new, that you just described. So we think you're going to see a major sector rotation in 2026 into 2027 from growth-oriented stocks, regardless of sector, into value-oriented stocks. That's kind of the way I like to articulate it differently than you just did. I agree with what you're saying. I'm just saying, like, growth and value is something portfolio managers, hedge funds, private equity, all these guys talk about this. Growth has been kicking value's butt for so many years in a row now that it's time. You're seeing this in the last 3 months right in front of you, right? We don't own IYM, but we own a ton of GDX. GDX is the biggest ETF in mining for gold stocks, and it's also mid to large cap in nature. So you're not seeing the small and micro stuff in there. The small to mid cap one is GDXJ. Probably looks pretty similar to GDX, but they had outstanding years last year. And David, I mean, when you look at the S&P 500, just as of December 31st, right? 37 to 38% tech. Guess how many, guess the percentage in mining stocks? 0.1% is represented in the S&P. So if you're sitting here watching this and you're saying, hey, I have a third of my whole net worth in my 401k and SPY, you don't own any mining exposure. You don't own any gold exposure. Like, these charts are kicking butt and you're not participating. So you have to work, again, with a professional that understands this stuff, because your traditional portfolio or your traditional advisor in the US, at least, is not talking about our sector at all. It's amazing.
Do you think that maybe institutions are going to eventually have to rotate out of these mining companies that they're perhaps more overweighted than now? Let's say they have a certain mandate to maintain a certain sector weighting, and now that weighting has expanded beyond their initial allocation allowance. That means they're going to have to take some profits. Are we there yet?
Absolutely not. No, we're not even close. I hear what you're saying, and I think it's a good point. But there's more and more people like myself that broke away from Wall Street that are doing it on their own. And they personally, I don't have any constraints, right? I don't have to be 80% invested at all times. I don't have to be 5% or less in a stock, right? These are traditional portfolio manager characteristics in the US, right? And they have to follow these guidelines. I get it. But there's more and more people breaking away and going independent. Like, we finished the year last year up 153% on our retail. And a lot of that was from our silver position, which was 17.8% at the end of last year. So we just bought and held all the way up, David. And we started to sell here in January, February, because we just had too much of an overweight.
Let's take a look at this headline here. China's central bank is buying gold for the 15th consecutive month. Now, at what point does central bank buying stop is my first question. And then we'll move on. First of all, let's take a look at why they're buying and why they would stop.
The why to stop would be the U.S. and China getting along, right? Which is not happening, in my opinion.
Sure.
I mean, we did sign the quote unquote agreement on critical minerals like rare earths and antimony and stuff in November with China. But I mean, that's a joke. That's an absolute joke. We've been taking the other side of the trade and buying rare earths, buying tungsten, buying antimony stocks right now, because you're not going to get a chance like this when people are talking down these little subsectors. I mean, just look at the price, David. Look at the spot price of tungsten. It's gone from $673 on average spot to $1375 last week since the agreement. So in 3 months to the day almost, the price of tungsten has gone up 100+%, not the stocks, just the spot price. So what is that telling you? It's telling you that we are at a point where we're short supply on some of these metals and minerals. And that's why US Exim and Trump, are starting to spend so much money in the critical mineral space.
This is a pretty interesting index here. World Uncertainty Index, Global GDP Weighted Average. It is now at the highest level on record, higher than after 9/11, higher than after the Great Recession of 2008, higher than COVID.
Wow.
By almost double.
Yeah.
And it's defined here, this is the St. Louis Fed, it's defined as index determines uncertainty using the frequency of the self-same word in the quarterly Economist Intelligence Unit country reports. Uncertainty has been front and center on CEOs' minds, by the way, off topic, at the conference board when they conduct their CEO surveys. But, okay, uncertainty as a theme, how correlated is this with gold and central bank buying of gold?
Heavily. So gold loves uncertainty. It loves bad news. I mean, globally, right? Like right now, you're seeing gold trade. I think there's two camps, David. There's people that believe in gold and silver, like Stan Druckenmiller, Ray Dalio, myself. People that clearly I have nothing, net worth compared to these guys.
Sure.
But there's a lot of smart, value-oriented people that have our back now, which is really different from when you and I met a number of years ago. Like our sector was struggling then. It is not struggling from a sentiment perspective now. I think gold is here to stay. Like any pullbacks are being bought generally. I don't see us getting back into anything with like 3,500 or lower. That would be a black swan event that neither you or I could really foresee. But that uncertainty that you just showed is really interesting because that's the backdrop. And yet the broad market is cranking like until this week, right? Like it's really disconnected.
What about silver? You told us last September on my show that $50 silver adjusted for inflation is really about $68 to $70. And now that we've blown past $100 at some point, 122 before it topped, what's the fair value today, you think?
Yeah, and in fairness, that was like 2011, 2012's inflation adjusted, not 1980. 1980 would be, whatever, 150 plus, right? So I still think silver is going higher this year. It's currently at 75 on the nose when we started recording. So from 75, it hit at 121, right? So that's your new resistance level, right? 115 to 121, right? Somewhere in there. Are we going to hit that again this year? I believe so. And so these silver equities are completely mispriced. Some of the names I follow were down 10 to 14% today. In the silver equity space because silver was down huge, right? So that's normal. But what's interesting, David, is that these silver equities, especially the juniors, didn't participate as much as you would have thought when silver was ripping higher, right? And now they're participating just as badly as silver on the way down. We call that taking the stairs up and the elevator down, right? Like that's not a good thing. It's not a good feeling as an investor. I know there's frustration from investors about this. All I can tell you is think about silver just trending here from 70 to 90 for a while. Like these silver equities are going to crush it over the next couple of earnings quarters because their all-in sustaining cost on average is like $20. We just saw silver do this, right? If you were to pull up a chart of silver, you'll see it looks like a hockey stick, SLV. But now it's consolidating and trying to find its footing. And that's normal in a huge rally.
Okay. And between gold and silver, which one do you like more right now?
Absolutely silver, because we had too high of a rally too fast. And now we're seeing these ridiculous 10 to 13% corrections on a daily basis sometimes. This is a metal. This isn't a stock. And it's a very needed metal. When I look at physical deliveries for March and certain months, like there's no physical out there. There could be a real shortage of silver this year, not next year.
Let's talk about some stocks now, mining stocks. Before we get into specific names that you're currently holding, tell us about how you pick mining stocks. The GDX and GDXJ have both risen tremendously. In a world where the bullion is rising and the entire index is going up 150% in a year, one has to wonder why we have to even pick stocks to begin with. Why not just buy the entire index? So clearly you have a methodology.
Sure. Yeah, sure. In a year like last year, I totally agree with you. GDX and J were primed to rip, and they did rip. I think GDX was up about 155, and GDXJ was up about 173. I was up 153, so I underperformed slightly and greatly on GDXJ because, again, that's an ETF that's fully invested at all times, David, right? Frictional cash. We would carry 8 to 10% cash on a given month because we want to have cash on hand for corrections like we saw today. But, when you look at our beta, our risk level, we were at a 0.51 over the last 3 years, and my average annual return is 58% on, which is crushing GDX and J with less risk, right? So we look at risk and return. It's not just about return. Look, gold equities are 51% of our everything as of December 31st. Part of that is by owning stuff like GDX and J. Part of it is by owning some juniors no one's ever heard of before, or very few people have heard of before. I can give you one or two. Denarius Metals, DNRSF in the States, DMET in Canada. I'm actually flying to Colombia, which is rare for me to go and put a hard hat on and check out a mine. But this is how much conviction I have in this stock because it's absolutely getting trashed right now. They have a ton of warrants that were being exercised. And when you exercise warrants, David, you know this. I mean, you put selling pressure on the stock, right? But now you have days like today, which is compounding that selling pressure. And the stock is just mispriced here at 39 cents US or 40 cents US. It's ridiculous. So we own that stock because they're already a gold producer, right? There's only like 175 companies out there producing gold in total. Like it's, very advanced for what it has. And they're going into production in a second mine in Spain by June. So we see a lot of upside there. Another one would be Triumph Gold. That one is TIGCF in the States and TIG in Canada. They haven't put out news in quite a while, but I keep in touch with the company every month. And these guys have a lot planned for this year, meaning they've bought a mine in Utah, in the USA for silver production. They're going to drill it, obviously, first, go through the development process, and then go into production years from now, right? So they can't capture today's silver price. No exploration company really can do that, right? But they have 2 million ounces of gold almost in the Yukon, and they have a ton of tungsten, which I love as a byproduct up there. And the stock is trading at 50 cents. I mean, there's just so much value in some of these names. So those are two that we like in the gold space.
Do you usually prefer developers or juniors in the exploration phase? In other words, which phase of the exploration and development process do you target? Before they get their PEA, after, right before they start going to production?
There's a lot of value to own developers right now, and the closer to production, the better, because they're going to be able to realize these high prices, right? So we, in the silver space, we own a developer called BlackRock Silver, BKRRF in the States and BRC in Canada. They have 108 million ounces of silver equivalent in Nevada. They just got $15 million from Eric Sprott and one other investor just a few weeks ago. So they're cashed up. They're in the right state. Andrew told me in an interview that he thinks that they could be in a construction decision in 15 to 16 months from right now. So there's a stock that will benefit, right? They're close enough to production that they will benefit from this non-dilutive money that Trump is handing out to people in the U.S. Another development stock that we just, literally interviewed, 3 weeks ago was Bear Creek, BCEKF in the States. Bear Creek is already getting bought by Highlander Silver next week, which is HLSCF. We think that deal goes through. Dan Earl, the new CEO of the combined company, was saying that, there's really not a lot of pushback on this merger. So when you see a stock like that at 58 cents, you're like, okay, they have 300 million ounces of silver, David. That makes it one of the top 10 largest undeveloped silver projects out there. But they have an advanced report on this project. It's called Karani, that they put out in 2019. Why haven't they updated it? Because they couldn't get it to production, Bear Creek, right? So now they're merging with a company called Highlander that can get it to production. And these are the things you have to kind of look for as an investor.
When we talk about a company getting into production, that's very costly. Sometimes I talked to a lot of mining companies. The capex alone exceeds their market cap by orders of magnitude. How, as an investor,
Right.
how do you pick companies that are going to, I guess, responsibly finance this transition without diluting your shares to zero?
That's a great question. I'm totally on board with that statement. I think some of these companies are way over their skis. Like if you look at some of these nickel companies that need like $1 billion and they're trading at 15 cents, like who's showing up to fund this thing, right? I mean, it's a total flyer. U.S. Gold is a good example. Okay, so that's USAU. I talk to George and his team monthly. It's my largest gold holding in full disclosure. The reason is they're in Wyoming and they have a big capex, right? So I'm concerned as an investor. I want to make sure they're going to do the right thing for shareholders. And in talking to George, he's like, look, John, I don't have to take 100% equity. I could take a portion in debt. And that makes really good sense to me, right? And we're entering a market now where a year ago, they may have struggled to raise that money. But now you're seeing Andean raise $96 million a few weeks ago. SilverX raised $60 million a few weeks ago. These juniors are raising money with like very little trouble because there's more and more interest in our sector. So I think USAU gets over the finish line in Wyoming and does it without a ton of dilution.
Do you have to pick, just finishing up here, management teams that want to go into production? Maybe they don't have an experience where a lot of experience as operators. What do you do then as an investor?
You need to talk to the CEO to find out what their game plan is because some teams can just be bought, right? Like Next Gold, NXGCF in the States, they have a great team. They can develop either of their two gold projects. They have 7 million ounces of gold. That's really exciting. Some projects, I totally agree with you. They don't have the team yet. And then you have to call them and say, what's the game plan? That's something that Don Durrett and I ask on every single interview. What's the game plan for the next 2 years? Not for 6 months. 2-year minimum. I want to see what you're going to do for me as a shareholder to get us to the finish line. And if you're saying to me, hey, we're just interested in selling this for a 25 to 30% premium, then I'm out of the stock. I'm not looking for 25%. There's too much risk, right? I mean, I want to see a path to production.
Okay. Finally, I want to get your thoughts on this piece of news. On the 2nd of February, so a couple weeks ago, Trump announced Project Vault. It's a landmark initiative led by the chairman of the Export-Import Bank of the U.S., which marks an unprecedented step in U.S. industrial policy by establishing a domestic strategic reserve for critical minerals. The EXIM board of directors approved a direct loan of up to $10 billion for Project Vault. Let's just finish the conversation on here. What are they planning to do, and how does this impact you as an investor?
Sure. Well, if you looked at a prior news release from November about US Exim, they announced $100 billion going towards critical minerals and energy, including nuclear energy, right? That kicked things off in November. This is a follow-up to that. So that adds up to $112 billion USD that's being thrown at critical minerals. Like, very exciting for anyone invested in the critical mineral space. This is telling you as an investor that Trump and the U.S. in general is serious about competing with China. Now, whether or not they get there, that's the $64,000 question. I still think you need a lot more investment to get, relatively competitive with China. Why? Because China produces 91% of the world's tungsten. It produces 65% of the world's tellurium. They have a complete and utter dominance in certain metals. And by the way, David, many of these are used in defense and technology, two very hot sectors, right? So Trump got the executive order out last March, and now you're starting to see follow-up through news releases that you just saw there. We like a couple of critical minerals names, and I'll wrap it up. We like PGE-ZF in the States, which is Stillwater. They're in Montana. Really, really cheap stock here at 29 cents. They just hit 50 cents a few weeks ago. I mean, they're down 42% in a couple of weeks on no bad news. It's crazy. Another one we've mentioned on your show before is Power Metallic, PNPNF in the States, PNPN in Canada. They have the best copper hole hits I've seen in 2024 or 2025 from any junior out there. And they have a lot of critical minerals like platinum and other things in their deposit in Canada. And lastly is Sydney. Sydney Resources is SDRC, trading again at 29 cents. I mean, these guys are in Idaho. This isn't the Congo. Like this is a real jurisdiction that's being more and more supportive of mining and writing checks that are non-dilutive to companies like this.
Okay, perfect. Thank you for sharing your thoughts and disclosing your portfolio for us. It's very educational. We'll end it here. John, where can we follow your work?
Yeah, thanks. It's fenneckconsulting.com. And if you go to performance, you can see our track record for 10 years. There's a ton of information there for investors.
Yeah, absolutely. We're not giving financial advice, but we're giving investors an opportunity to learn from professional investors like John what they are doing. So do your own due diligence and make sure to follow the channel for more updates daily. Thank you, John, for your time today. We'll speak again soon.
Thanks a lot, David.
Thanks for watching. Don't forget to like and subscribe.